Welcome to the 2014 Hedge Fund Compensation Report Summary, brought to you by hedgefundcompensationreport.com. In our many years of publishing the annual compensation report, we've seen significant changes in how hedge fund compensation works. We feel a responsibility to present a compensation benchmark resource that's comprehensive, reliable, and affordable. Our goal is to create an accurate and affordable industry benchmark, and we survey hundreds of fund managers' employees every year. Firms both large and small are represented, and we get responses from all over the world, with a concentration from North America. And of course, all personally identifying information is kept confidential, as the results are only shown in aggregate. Over the years, the report has grown into the most comprehensive and reliable benchmark resource on the market. This year's report, with more than 40 detailed charts and graphs, should provide you with all the information you need to better understand comp practices. The report analyzes data related to cash compensation, levels of equity, work satisfaction, and much more. It also seeks to clarify fund performance and how that relates to pay expectations, especially when it comes to bonuses. This report is unique in that figures are based solely on data collected directly from hundreds of hedge fund professionals. Given that nearly 90% said that their fund performed positively last year, it's not surprising to see that they were very optimistic about their comp. More than 60% expected their pay package to exceed last year's total. 31% of hedge fund employees were expecting 15 to 100% more money, while 5% expected to see their comp more than double, which is similar to what we reported last year. Total compensation grew by 16% last year, and we saw that there was an overall upward movement in cash comp. In 2013, there were fewer professionals earning $50,000 to $150,000 and more earning $150,000 to $250,000. In all, 3/4 of hedge fund professionals earn between $100,000 and $500,000. Now, it's important to understand what the primary drivers of compensation are. The three primary drivers in the compensation formula are experience, performance of the fund, and size of the fund. And regarding fund size, bigger is not necessarily better. Although the industry is often referred to as a meritocracy, there is a disconnection between individual performance and fund performance. And one thing to keep in mind, common titles such as analyst, director, risk manager can and do mean very different things to different firms. This is especially true at the smaller firms, where each person tends to wear more hats than their larger firm counterparts. Last year, 26% said that they were employed at firms with $1 billion or more in assets in their most recent fund, compared with 22% this year. Meanwhile, at the bottom end, 29% worked at firms with less than $100 million, and last year that number was 34%. Now, industry reports indicate there's a shift towards larger funds, and we saw that shift last year. Big funds were getting bigger as they attracted the bulk of new money flowing into the industry. Small funds were having trouble raising their initial money. This year, however, we did see a slight shift back towards the smaller fund sizes. Both the markets and these funds had a good year in 2013. A full 90% reported gains at their funds. 1/3 reported gains of up to 9%, and another third reported gains between 10 and 24%. This year, an incredible 18% enjoyed gains of 25% or more. Fund profitability explains why total cash comp was up strongly again this year. Most employees worked at funds that were positioned to award substantial bonuses. Last year, we projected there would be strong performance with bonus awards to match, due to many funds reaching their high watermarks. With loosening hedge fund marketing restrictions, we expect 2014 to be another strong year in terms of hedge fund professional earning levels. At hedge funds, the bonuses typically come in from the performance fees. The better the fund performance, the bigger the incentive fee pool, and hopefully the bigger the bonus payouts. Both last year and this year, this played out perfectly in the bonus numbers. We've seen years where this wasn't exactly the case. When comparing the figures to last year's report, we find a very similar situation. Last year, those funds that were up 10% or more took home an average bonus of $218,000. This year, those at that return level earned $210 in bonuses. Again this year, This is about 50% higher than the bonuses awarded to those that were up less than 10%. The survey participants who reported pay over $1 million worked at firms that were experiencing very good performance last year, with over 80% expecting double-digit returns. The bonus represents a major portion of compensation for the 12% of hedge fund employees who made between $500 and $1 million. Bonus accounted for 73% of total earnings for this group. For those earning between $300 and $500, bonus represents 54% of total cash comp. And bonus still plays a major role in compensation for the nearly 3/4 of respondents who earn between $100,000 and $500,000. While bonuses account for most of the highest earners' pay and are a significant share of the pay package of most employees, each year the majority of professionals tell us that bonuses are far from being a sure thing. This year, 84% said none of their bonus was guaranteed, and this number is higher than last year's 80%. This year, the full bonus is guaranteed for only 4% of hedge fund employees as compared to 5% last year. 7% said that more than half of their bonus was guaranteed, which is slightly lower than what we've seen in the past. In some cases, however, these bonuses do come with strings attached. 16% of all respondents said that they are required to invest some of their bonus back into the firm's fund, and that number is up from 13% last year. While bonuses play an increasing role in total compensation, equity is the compensation element that makes the biggest difference long term for many of the employees. Hedge fund founders know that minimizing turnover of key players is critical, especially since many of these small firms run very lean. They use equity as a retention tool and as an incentive in the hiring process to entice that top talent to come aboard. Last year, 27% reported having an equity share, which was down from 29% in the year before and 35% the year before that. This year, that number climbed to 28%. If we break out how the equity is shared, 20% have a 2% or less ownership position, which is up from 14% last year. 18% have a 3% or higher ownership stake, and that's up from 14% last year as well. Simply put, the more work experience someone has, the more likely they will have equity participation in the firm. For example, about half of those with 16 to 19 years of work experience own a piece of the firm, and 60% with 20 years or more report having equity. However, this year we did see something different from prior years. While 27% of those with 10 to 15 years of work experience own some equity, 36% of those with 6 to 9 years of work experience have equity. And that's the highest we've seen over the years that we've done this report for that level of work experience. And again this year, those with less than 2 years of work experience said they do not have any equity in their firm. So who's happiest with compensation? Well, partners and principals led the way with an unusually high 79% pay satisfaction rating. Now keep in mind, this group also reported earnings that were up nearly 60% from the prior year, so a big jump in satisfaction would be expected. Chief investment officers were next in line with a very respectable 64% satisfaction rating. Additionally, the finance team, directors, legal and compliance officers all had pay satisfaction ratings of over 50%. Once again this year, portfolio managers and senior associates were toward the bottom of the satisfaction rating. We don't have time here to cover everything in the report. And as you can see, that we've got 44 different charts and graphs in this year's report that detail out everything from base versus bonus pay this year versus last year, year-over-year compensation changes, compensation by title by fund size, all detailed out, all available for instant download. If you'd like to learn more, I invite you to check out hedgefundcompensationreport.com. There you can get instant access to the full report and even download a sample of the report. On behalf of all of us who took great care in creating the Hedge Fund Compensation Report, we'd like to thank you for your time and for your interest. We hope this video was helpful.